JP Morgan just closed a massive short position in silver right at what looked like the exact market bottom on Friday. And then, almost immediately, the public story became, this happened because of the Fed chair news. And I'll be honest with you, I wasn't even going to make this video. Looking at my phone and thinking, what on earth just happened in silver? Because what played out wasn't a normal markets being markets day. It felt like a flush, a forced liquidation event, where everything that could hit at once did hit at once. Mainstream coverage is already pushing a neat, simple explanation. But the simple explanation doesn't match the timing, the mechanics, or the sequence of coincidences that showed up around and the crash. So in this video, I'm going to walk you through the full story as I see it, based on how futures markets work, how margin works, what happens in crowded trades, and why silver's paper price can fall violently, even while physical supply dynamics remain tight. Now, before we go any further, this is important. Pause. I'm not accusing anyone of wrongdoing. I'm not offering financial advice, and I'm not telling you what to buy or sell. I'm explaining what happened through the lens of market structure, because if you hold silver, gold, miners, metals, ETFs, or honestly any asset that trades with leverage and derivatives, you need to understand this playbook. Because whether this move was natural, coincidental, or engineered, one thing is true. A crash like this can either become the best opportunity of the year, or it can scare you out at the worst moment, right before the next leg higher. And if you have a 401k, savings, bonds, cash, ETFs, anything, understanding forced liquidations and how they get triggered can make the difference between protecting your wealth and getting blindsided during the next big monetary shift. All right, let's break it down. What just happened? The move that shocked everyone. Here's the headline move. Silver tagged around $120 on Thursday, a blow-off top, peak moment. Then by Friday it dumped hard, down towards $78 in the sell-off. That's a brutal drop, roughly 35% in a very short window. Gold also got hit, down around 12% in the same wave. Miners got smashed. Silver miners, gold miners, everything correlated to metals got nuked. Even if your exact numbers differ by feed or instrument, the core truth remains. This was one of the most violent silver dislocations many traders have ever seen. Now, what did the mainstream narrative say? They said, a new Fed chair rumor appointment changed expectations. Stronger dollar, less printing, metals down. And yes, Fed expectations and the dollar absolutely matter. But here's what bothered me. The Fed chair story is a convenient explanation. It's a clean headline. It's something a casual viewer understands. But it doesn't explain the sequence of market mechanics that actually turns a sell-off into a waterfall. So let me show you the sequence. The coincidence stack that made people furious. When you look at the timeline, you get a cluster of events that, at minimum, raise eyebrows. 1. The perfect bottom short cover. The chart action showed what looked like a major short position being closed right at the low, the kind of timing that makes retail traders feel like they're playing poker against someone who can see the next card. Again, I'm not claiming illegal activity. I'm saying the timing is what it is. 2. The London Metal Exchange, LME, disruption. On the same day, there was a reported disruption outage-type event with the London Metal Exchange, one of the most important global venues connected to metal price discovery. 3. Another big player having systems issues. At the same time, there were reports that another major institution connected to metals positioning had systems trouble as well. 4. COMEX CME margin hikes. Then you get the part almost nobody on mainstream TV wants to focus on. Margin requirements. Because margin is not just a technical setting. In a leveraged derivatives market, margin is the on-off switch for forced liquidation. When margin jumps abruptly, the market doesn't decide to sell. Traders are forced to sell. 5. Timing around market liquidity windows. And the sell-off timing also matters. Liquidity isn't equal across global sessions. If you wait for certain regional markets to close, you can sometimes hit thinner conditions where moves travel farther, faster. 6. A news catalyst lands on top. Then, after the structure is already stressed, you drop a catalyst, like new Fed chair, and it becomes the match on a pile of dry wood. Now, maybe these are all independent events, maybe it's coincidence, maybe it's just the way the world works. But if you've watched silver across decades, you already know why traders call it the widowmaker. Because silver doesn't move like a normal asset. It moves like a market that can be pushed around through leverage mechanics. The three things you need to understand so you're not the exit liquidity. Here's what I want to do. I'll keep this tight and practical because it's freezing out here and I'm holding a camera in the snow. I want to cover three things. What actually triggered the massacre mechanically and who benefited? Why the crash didn't fix the silver story, it may have strengthened it. What smart moves look like after a forced liquidation, risk management, not buy this. Let's go. 1. The real trigger, forced liquidation, not just a headline. Headlines do not crash a market by themselves. Headlines create uncertainty. They create repositioning. They create volatility. But what creates a straight-line cliff drop is usually forced liquidation. And forced liquidation in futures markets is driven by two main mechanisms: stop losses getting hit, margin calls forcing sales. Stop losses are voluntary-ish, margin calls are not. Margin calls are liquidation by necessity. Why margin is the hidden weapon. A futures contract allows you to control a large notional amount of silver with a relatively small amount of capital, margin. Example, simple illustration. You control $100,000 of silver exposure. You post $10,000 margin. That's 10-to-1 leverage. Now imagine the exchange raises required margin from 10% to 20% or 30%. Suddenly, you must either deposit more cash immediately or reduce close positions. In a crowded trade, most traders are already using a large portion of their margin. So when margin jumps, many can't add cash fast enough. So what do? They sell. And when they sell, price drops, which triggers more margin stress, which triggers more forced selling, which triggers algorithmic sell cascades, which triggers more stops. That's how you get a waterfall. A normal sell-off becomes an air pocket. And yes, this is exactly why margin changes have historically lined up with major silver turning points. 2. The Fed chair story. The match, not the fuel. Now let's address the public narrative. Trump nominates Kevin Walsh as Fed chair, hawkish perception, and markets panic. Here's the truth. A hawkish Fed expectation can strengthen the dollar, raise real yields, expectations, reduce easy money assumptions, pressure gold and silver. So, as a catalyst, it makes sense, but as the explanation for a historic silver crash, it's incomplete, because the bigger driver was this: silver was a crowded trade. When everyone is on one side of the boat, retail, funds, institutions, then even a small catalyst can trigger a liquidation event. And once liquidation starts, it doesn't care about your thesis, your macro view, or your long-term conviction. The market becomes a forced auction. 3. The part most people miss. Silver trades in two markets. To understand why I'm not convinced this crash solved anything, you need to separate A. The paper market, futures or derivatives. This is where most trading volume happens. It's leveraged, fast, and dominated by futures positioning, options flows, dealer hedging, algorithmic activity, margin mechanics. Paper price can move violently because leverage is being unwound. B. The physical market, bars, coins, industrial supply. This moves slower. It's driven by real supply, real demand, and real delivery constraints. You can slam paper price in a day. You cannot print physical silver into existence. So if the underlying story is strong industrial demand, solar, EVs, electronics, data centers, multi-year supply deficits, the claim often cited is around a to 200 million ounces annual deficit range, tight availability in key regions, rising physical premiums, then a paper flush doesn't magically create more metal. It just resets leverage and sentiment. That's why people say paper crashes can be setups for the next physical-driven move. The smoking gun many traders look for: margin data. When silver crashes and nobody can explain the violence, serious traders look at margin requirement changes, open interest changes, commitment of traders, positioning, dealer gamma exposure, liquidity conditions. Because those show whether the move was risk-off repositioning or forced liquidation or position reset. If margin was hiked aggressively into a crowded market, you don't need a conspiracy to explain the cliff. The structure does it for you. Historical pattern. Why silver traders have seen this movie before. This is not the first time silver has done this. 1980. Buy restrictions, rule changes, and collapse. Silver surged, then exchange rules changed, leverage got squeezed, and price collapsed. Retail got destroyed. 2011. Repeated margin hikes, huge drawdown. After the post-2008 metals boom, margins were raised multiple times. The result was a sharp decline that felt like a controlled reset. 2025. Thin liquidity plus margin pressure. The holiday move. During thin conditions, margin changes and forced liquidation can do outsized damage quickly. 2026. Same playbook, bigger shock. If the structural ingredients align, crowded trade plus leverage plus margin stress plus catalyst, then you get the 44-year type crash traders are talking about. Again, I'm not saying anyone pressed the crash button. I'm saying the machine has buttons, and margin is one of them. So how do I know the bottom is in? This is the question everyone asks. Will silver test $55 next week, or bounce back to $100 fast? Is this the buying opportunity, or the start of a longer unwind? Here's the uncomfortable answer. If you're trying to time the exact bottom in a forced liquidation event, you're playing the most difficult game in markets. Because the bottom isn't set by fundamentals in the moment. It's set by when forced selling ends, when margin calls finish, when liquidity returns, when big players stop absorbing and start bidding. That's why people panic sell the low. They can't tell the difference between price discovery and forced liquidation. What I would say to anyone holding metals: risk management, not advice. Let me keep this simple. 1. Stop using leverage on widowmaker assets. Leveraged silver ETFs getting smoked is not surprising. Silver already has enough volatility. Adding leverage is like adding gasoline to a house fire. 2. Position size is everything. If a position is so large that it ruins your sleep, it's too large. Markets will always find the maximum pain point. 3. Decide your time horizon. Are you trading days, weeks? Investing months, years? Holding as insurance? Your strategy has to match your horizon or you'll get shaken out. 4. Separate paper noise from physical reality. If physical premiums remain elevated and deficits persist, then paper crashes may not invalidate the long-term thesis. They may simply reset the board. Why I think the thesis didn't die, it got clearer. Here's the part Wall Street never wants retail to internalize. Paper price can be pushed around by leverage mechanics, but physical constraints don't disappear. If anything, a flush clears leverage, allows shorts to cover reset sentiment, and gives the market room to run again later. Does that guarantee new highs? No, nothing is guaranteed. But it explains why silver can look broken on Friday and unstoppable weeks later, because the driver changes from leverage to fundamentals. Final word and the real lesson. Mainstream media will tell you Kevin Walsh, the Fed chair, rumor crashed silver. That's a clean story. The more complete story is crowded positioning, a catalyst, margin pressure, forced liquidation, thin liquidity windows, algorithmic cascades, and a paper market reset. That combination creates the kind of crash that makes people swear off metals forever, right before the next leg up. So whether you believe this was coincidence or you believe there was intent behind it, either way, the defense is the same. Understand the structure, respect leverage, control position size, and don't let a forced liquidation event hijack your long-term plan. Because if you hold a 401k, bonds, cash, ETFs, metals or stocks, the mechanism you saw here, forced liquidation via margin, is the same mechanism that shows up in every major market stress event. And we are heading into a period where monetary policy shifts, geopolitical stress, and liquidity cycles can make these events more common, not less.